In this market, the real danger is never the pullback itself, but the way you slowly give up your defensive awareness during an uptrend. The indexes keep printing new highs, while the VX rises at the same time. That's not money retreating. That's money actively raising its survival rate. Today, we're doing just one thing: to see clearly how the market is repricing risk. Hey everyone, I'm Peter. Today is January 9th, 2026. Let me start with something many people will resonate with. Right now, the market looks like it's full of opportunities, but the moment you actually want to act, everything suddenly feels off. If you feel this way, it doesn't mean you've become more conservative. It means the market itself does not want you to be aggressive at this stage. The market is truly focused on only two things right now. First, the December non-farm payrolls data, which determines the medium-term direction of U.S. equities in January and February. Second, the Supreme Court's tariff ruling. However, this event is more of a short-term disturbance for the overall index, with its impact mainly concentrated in tariff-sensitive sectors such as consumer goods, retail, apparel, and footwear. Morgan Stanley's view is relatively neutral. Even if the ruling goes against the White House, the macro-level impact would likely remain limited. You must clearly distinguish the weight of these two events. Non-farm payrolls is a directional level variable, while the tariff ruling is more like phase-based noise. The biggest problem many people are facing right now is putting all news on the same analytical level, getting scared by macro headlines one moment and pulled around by news the next, until they no longer even know what they're trading. From a volatility perspective, the VX has not moved meaningfully higher, indicating that the market has not significantly increased protection ahead of non-farm payrolls. Volatility remains within a controllable range, suggesting traders do not expect an extreme surprise this time. At the same time, positioning has not expanded either, reflecting a very typical state: not panicking, but not betting. This is actually a very mature market signal. When something truly serious is about to happen, the VX usually loses control first. The fact that it hasn't means the market is calculating probabilities, not gambling on luck. Ironically, many retail traders feel the most anxious in this environment because they're used to being either heavily long or heavily short. But the market's current message is clear: don't rush to pick a side. The recent violent swings in precious metals are not driven by a sudden deterioration in fundamentals. The core reason is the technical impact of the BM index's annual weight rebalancing. During the rebalancing period, passive funds must reduce exposure to gold and silver according to rules, regardless of whether prices are reasonable or long-term logic still holds. This type of selling pressure is mechanically executed and often creates sharp short-term sell-offs that look extremely frightening. You keep asking yourself whether you missed some major information or whether someone already knew the outcome in advance, but you must clearly distinguish this. What you're seeing is passive capital executing rules, not market consensus reversing. These two things are completely different. If you try to fight short-term mechanical selling with long-term logic at this stage, you'll only get repeatedly worn down. Bitcoin's sharp drop looks more like a cleanup of momentum chasing capital after breaking below $90,000 intraday. Price quickly rebounded, and liquidation data shows that liquidations were mainly concentrated in highly leveraged long positions rather than long-term holders. This indicates the decline was not a collapse of belief, but a cooldown after structural overheating. Whether Bitcoin can regain strength still depends on liquidity expectations, especially whether a rate cut occurs in January. Bitcoin has become very difficult to understand as a purely sentiment-driven asset. Its sensitivity to liquidity is extremely high. It's almost like a magnifying glass. The moment the market starts doubting liquidity timing, Bitcoin reacts first. So if you're only staring at a few candles, it's easy to get repeatedly shaken out. What really matters is whether macro conditions realign. From an index structure perspective, both QQQ and the S&P 500 are currently in a very typical waiting at key levels phase. Price has not broken down, but it also refuses to confirm a breakout. QQQ's key anchor remains the 620 level. As long as it is not decisively broken, the overall structure remains intact. But ahead of non-farm payrolls, the market clearly does not want to make an active directional choice. Honestly, this is the kind of market that most easily drives traders to question their sanity. You'll find that all the techniques, structures, and models you've learned are not wrong. They're just not effective right now. You enter, it doesn't move. You exit, it rallies. Many people start doubting themselves at this point, but it's not that you're incapable. It's that the market simply isn't rewarding proactive judgment. Apple has been declining consecutively and has now entered a short-term oversold zone, making an emotional rebound possible at any time. But the issue is that this decline is not just a technical adjustment, it's compounded by uncertainty stemming from management succession rumors. In the absence of clear catalysts, large cap tech as a whole has entered a phase of premium erosion. Capital is not unanimously bearish, it is stepping aside or exiting as uncertainty rises. Many people now have this thought about big tech: it's already down, should I buy the dip? But you need to think carefully. The market isn't saying it's expensive, it's saying it's unclear. When an asset that was once treated as a certainty, anchor starts showing ambiguity in strategy and rhythm, capital's first reaction is always the same: step away first. The defense sector currently shows a very typical carrot and stick structure. On one hand, policy pressure is applied to executive compensation, dividends, and buybacks, pushing companies to accelerate capacity expansion and delivery. On the other hand, long-term expectations for increased defense spending are being reinforced. This combination keeps the medium to long-term logic intact, but makes short-term price action highly prone to sell the news volatility. You clearly know the long-term direction is favorable, but price refuses to move at your pace. Many people make the mistake of using long-term conviction to absorb short-term volatility, only to end up losing on mindset rather than logic. I always emphasize one thing: long-term logic is not an excuse to avoid short-term stop losses, and short-term volatility is not evidence that the long-term thesis is wrong. NVDA is currently at a very sensitive point. Technically, price has broken key structural support. If it fails to recover quickly, the previous pattern may be invalidated and downside space opens up. At the same time, readers reported uncertainty around China H200 order approvals, and supply has pushed enterprise customers into a wait-and-see mode. Before policy becomes clear, related demand is unlikely to be released quickly, and the market prefers to price this uncertainty in advance. What core assets fear most is not bad news, but not knowing whether it could get worse. That's exactly NVDA's situation right now. It's not that the logic has completely collapsed, it's that the number of variables has suddenly increased. In response, the market's standard move is simple: reduce exposure and wait for answers. APLD attracted strong buying after beating earnings expectations and significantly narrowing losses, with price surging intraday. However, from a technical standpoint, a clear long upper wick appeared again on the daily chart, closely resembling formations seen at several previous local highs. This pattern does not necessarily indicate a trend reversal, but it clearly signals that short-term profit-taking is emerging and pullback risk is rising. The most dangerous thing about stocks like this is that you've already made money and now you don't want to leave. You keep convincing yourself that this time the fundamentals are different, that this logic is stronger, but the market doesn't care whether you made money. It only cares whether the chips are starting to loosen. For me, there's only one principle with this kind of stock: protect profits first, talk about belief later. Driven by geopolitical events, policy support, and AI narratives, the drone sector has become a focal point for short-term capital speculation. The Pentagon's classification of drones as consumables simplifies procurement processes, providing a structural foundation for demand release. At the same time, AI transforms drones from tools into intelligent agents, leading to a reassessment of long-term market potential. From a trading perspective, the smaller the float, the greater the elasticity, and the greater the volatility. This segment of the market can be summed up in one sentence: you're trading volatility, not certainty. Many people see defense plus AI and immediately want to go all in for the long term. But you need to understand that the rhythm of these themes often runs much faster than your patience. Heavy positioning makes it very easy to get shaken out intraday. That's why I prefer to treat it as an emotional amplifier rather than a core allocation. Netflix is currently constrained by uncertainty surrounding acquisition negotiations, speculation around a potential WBD transaction continues, and until the outcome is finalized, capital is unlikely to return. Even though the fundamental logic has not been invalidated, price will likely remain range-bound until uncertainty is resolved. Right now, the market doesn't lack direction or logic. It lacks confirmation. Before confirmation appears, defense is not cowardice. It's respect for capital. If trading feels harder lately, that actually means you're taking risks seriously. I'm Peter. Remember to subscribe and like.